You know, usually when we look at the basic laws of supply and demand, we expect a certain level of, well, logic.
Right, like a baseline of common sense.
Yeah, exactly.
Right.
It should operate a lot like gravity. Like, if there is a massive oversupply of something in the market and absolutely nobody is buying it, the price of that thing is supposed to drop down to earth.
I mean, it is the most foundational rule of economics. You flood the market with inventory, demand dries up, and prices just have to fall to clear that excess out.
But then you step into the world of commercial real estate in one of America's biggest cities, and suddenly that economic gravity just, well, it completely stops working.
It really does.
We are looking at a market right now where almost 1 in 4 offices are sitting completely empty, yet somehow the rent they are charging for those empty offices is actually going up.
Which defies total common sense on the surface. I mean, you're looking at the absolute definition of a structural market paradox here.
Welcome to another deep dive. Today, our mission is to decode this exact paradox. We are pulling our insights from the Q2 2026 Greater Houston Citywide Office Market Report, which was put together by Lee & Associates.
It's a fantastic report, too.
It really is. And our goal here isn't just to rattle off, square footage stats and lease rates. We want to uncover what this data actually reveals to you about the shifting day-to-day realities of how and where business is being done today.
To even begin to understand this paradox, you have to picture the broader economic backdrop of Houston in mid-2026.
Right.
Because if you just looked at the office vacancy, you might assume the city was in some sort of depression. And it isn't.
Far from it.
Exactly.
Yeah.
Think of Houston right now. The economic engine is absolutely roaring. The regional rig counts are pushing up near 600. West Texas Intermediate crude oil is holding strong around $85 a barrel.
And people are working. I mean, the unemployment rate is sitting at 4.6%, which is tracking right alongside the national average of 4.3.
Yeah. Plus, if you drive down to Port Houston, they're pushing nearly 400,000 cargo containers in a single month alone.
That's massive.
It is. The traditional pillars of this city's economy are firing on all cylinders. Trade is moving, energy is pumping, and money is exchanging hands.
Which makes the data we are about to look at regarding the literal skyline of the city so incredibly intriguing to unpack. Because the windows in those skyscrapers are telling a completely different, almost contradictory story compared to, like, the port or the oil fields.
They really are.
Okay, so let's unpack this. The numbers here are staggering. The direct vacancy rate for the entire Houston office market in Q2 of 2026 is essentially 23%. Actually, 22.9 to be exact.
Right.
Now, yes, the report points out that is a tiny fraction better than what we saw in Q1, down 20 basis points. But we are still talking about nearly a quarter of all office space in a major metropolitan hub sitting entirely empty.
And you walk through certain downtown corridors,
Yeah.
and the physical reality of a 23% vacancy rate is highly visible.
You can feel it.
You really can. The lunch spots are quieter, the parking garages have plenty of open spaces. It is a historically elevated level of emptiness.
But despite that massive vacancy, the weighted average asking gross rent didn't drop a single cent. It actually increased by just over 1% quarter over quarter.
Yeah, it's wild.
It now sits just north of $31 per square foot, like 31.48. This feels like going to a movie theater, seeing that 75% of the seats are empty, and the theater management deciding to charge you more for your ticket just because you walked through the door.
That's a great way to put it.
How are landlords getting away with this?
Well, that movie theater analogy perfectly highlights why commercial real estate is so uniquely strange. The mechanics operate on a completely different financial level than, say, a retail business.
Oh, so?
A movie theater just needs cash to pay for the popcorn and the projectionist. A commercial skyscraper's entire financial existence is tied to its rent roll. What we are seeing here is landlords maintaining incredibly strict pricing discipline.
Okay, I hear you on discipline, but at a certain point, a landlord has to pay their own mortgage. Why wouldn't they just slash their base rent to, I don't know, $20 a foot, undercut the building next door, and get some paying bodies into those empty suites?
Because doing that is essentially financial suicide for a commercial property owner.
Really?
Oh, absolutely.
Mm-hmm.
Commercial buildings aren't valued the way a residential house is, where it's all based on what the house down the street sold for.
Right, there are no neighborhood comps.
Exactly.
Yeah.
Commercial skyscrapers are valued almost entirely mathematically, based on the cash flow they generate, basically the net operating income.
Okay.
So if a landlord permanently lowers the base rent just to get a tenant in the door today, they mathematically destroy the total appraised value of the building itself.
Ah, so the rent dictates the value of the asset.
Yes, and that triggers all sorts of nightmare scenarios behind the scenes. These buildings carry hundreds of millions of dollars in debt. And the banks that issue those mortgages have strict covenants. If the building's overall value drops below a certain threshold because the landlord slashed rents, the bank can step in, declare a default, and literally take the building.
Oh, wow. So landlords hold the line on the base rent to protect the valuation on paper?
Exactly. They have to.
They protect the ticket price. But they still need the tenant. How do they actually convince a company to sign that $31 a foot lease when the building next door is equally desperate?
By competing aggressively on literally everything except the base rent.
Like what?
Well, instead of lowering the actual price per square foot, landlords are handing out massive tenant improvement allowances.
Okay, so paying for the build-out.
Exactly. They're basically saying, pay our base rent, and we will hand you a blank check to completely custom build the interior of your office. They offer aggressive leasing concessions, like a year of free rent up front.
A whole year?
Yeah, sometimes. And most importantly, they are pouring their own capital into upgrading the common amenities of the building itself.
Oh, so it's less about trying to fill the empty seat and more about dramatically upgrading the quality of the seat you're sitting in.
Which causally drives us directly into the defining trend of this entire market report, and really the defining trend of post-pandemic real estate across the country.
The flight to quality.
Yes, the flight to quality. Because landlords are pouring money into these top-tier buildings, tenants are actively fleeing their older, outdated spaces to move into them.
We see this phrase constantly in the data. Let's look at the gap here, because it is massive. Class A asking gross rents have jumped to nearly $37 per square foot. It's at 36.63.
Yep.
That is up 5% from just a couple of years ago. Meanwhile, older Class B asking rents are sitting stagnant down around 23.23. That creates a pricing gap of over $13 per square foot between Class A and Class B spaces.
And historically speaking, a $13 gap is extraordinarily wide. Usually those two classes track relatively closely together.
But right now.
Right now, they're operating in entirely different realities.
And when you zoom in on specific submarkets, the differences get absolutely wild. Like over in the Katy Freeway East submarket, Class A space is commanding a whopping $60.78 per square foot.
Which is huge for Houston.
Huge. And the Woodlands is pulling in over 45. But then you look at an area like the North Belt or Greens Point, and their Class A vacancy rate is over 53%. More than half the premium space is empty.
Which tells us that tenants aren't just blindly looking for any building labeled Class A.
Right.
They want premium buildings in highly specific, desirable submarkets that offer a very specific lifestyle for their employees.
I have to challenge this premise a bit, though. Doesn't this just mean companies are burning money on flashy lobbies, rooftop gardens, and, I don't know, in-house espresso bars when they could get perfectly good Class B space for a fraction of the cost?
It looks that way from the outside.
I mean, a $13 gap per square foot across a 50,000 square foot corporate footprint is hundreds of thousands of dollars a year in savings. Why throw that away for a nicer lobby?
What's fascinating here is that corporate occupiers don't view this as a vanity expense or throwing money away at all. They view it as a core operational strategy.
How so?
Well, we have to define what actually separates these buildings. Class B isn't just a lobby without an espresso bar. It's fundamentally outdated infrastructure. We're talking about older HVAC systems that can't handle modern air filtration standards. We're talking about low ceilings, terrible column spacing that makes open concept floor plans impossible, and, crucially, a lack of high-speed fiber optic integration.
So it's not just cosmetic, it's structural.
Highly structural. And you have to pair that structural difference with the ongoing battle over the return to the office.
The RTO mandates.
Exactly.
Yeah.
Companies are trying to mandate that their employees come back 3, 4, 5 days a week. But you cannot mandate a return to a dreary, poorly lit, outdated cubicle farm in a Class B building without facing a massive talent revolt.
I hear that. I mean, the commute alone, sitting in an hour of traffic on I-10, makes people miserable, make the destination miserable too.
Precisely.
But are employees actually falling for this carrot? Or is the premium space still sitting empty?
The data strongly suggests they're falling for it. Companies are essentially buying operational efficiency and collaboration space.
Okay.
They know they need these premium environments to attract top talent in a tight labor market. Because of that, the The older commodity Class B buildings are facing intense competitive pressure.
They can't keep up.
No, they are genuinely struggling to gain any occupancy at all because they simply can't offer the technical or environmental standards that modern companies require to lure workers out of their home offices.
So companies are upgrading their spaces specifically to lure workers back, and landlords are playing along by offering custom build-outs to protect their building valuations.
That's the ecosystem right now.
If we look at the actual numbers, is this massive game of musical chairs actually resulting in positive momentum?
It is, and you can see it clearly when you look at the absorption numbers for the quarter.
Let's talk about absorption, just to frame this contextually based on the report. In the first quarter of the year, we saw negative net absorption, meaning more space was being vacated than leased, hitting nearly 280,000 square feet in the red.
Right, 277,613 to be exact.
But in Q2, net absorption rebounded aggressively to a positive number, pushing almost 500,000 square feet, like 496,066.
That is a staggering turnaround. You are looking at over a 770,000 square foot positive swing in a single 3-month period.
It's a complete 180. And overall, leasing activity hit 2.37 million square feet in Q2 alone. The report also points out that Houston is actually outperforming both the national average and the Dallas-Fort Worth area in daily office attendance.
Yeah, which is an incredible stat.
Austin still leads the pack in Texas, but the momentum in Houston is undeniably real.
It is real, but we have to look beneath the hood at who is actually driving this momentum, because that roaring economic engine we talked about at the beginning isn't pushing evenly across all industries.
Right, the leasing activity is highly concentrated. The job sectors that are eating up this physical space are professional and business services, which saw solid job growth up 1.5% to roughly 572,000 jobs,
Yes.
and education and health services, which also grew 1.5% to nearly 475,000 jobs.
Those are your heavy hitters in this market. Healthcare systems, law firms, engineering groups, major corporate consultants.
Meanwhile, the tech and finance sectors are apparently staying on their couches. The information sector actually shrank by 3.6%, and financial activities were down almost 2%.
Yeah, quite a drop.
Why is the divide so sharp? Why are the lawyers expanding their physical footprint while the tech startups shrink theirs?
It comes down to how those specific industries operate on a fundamental level. A law firm deals with extreme confidentiality, physical document rooms, and a partner track culture that is deeply built on FaceTime and mentorship.
Right, you have to be in the room.
Exactly. An engineering firm needs massive collaborative spaces to review physical plans. They require a localized physical presence. Tech, on the other hand, built its entire infrastructure on the cloud.
Ah.
Their work lives on a server, not in a boardroom. They adapted to fully remote work faster because their product is inherently remote.
Which perfectly explains the two massive leases the report highlights to prove this point. You have Mitsubishi Corporation taking over 91,000 square feet right in the central business district.
Heavy industry, physical operation.
Exactly. And then Dow Chemical is commencing a gargantuan 203,000 square foot lease out in Katy Freeway East.
Which, connecting the dots back to our pricing discussion, is commanding over $60 a square foot for Class A space. Dow is clearly willing to pay a massive premium to secure top-tier, highly amenitized space in a highly desirable submarket for their workforce.
So, what does this all mean? I want you, the listener, to think about your own industry for a second, whether you are in healthcare, tech, finance, or energy. The growth or the contraction of your specific sector isn't just an abstract number on a spreadsheet.
No, it's very real.
It is directly, physically impacting the skyline of the city you live in. If you work in tech right now, your industry's shift in behavior is leaving empty floors in the sky. If you work in healthcare or professional services, your industry is the one driving the construction of the in-house barista bars and the rooftop gardens.
The physical layout of the city is just a mirror reflecting the behavioral realities of the labor market.
Okay, but this brings me to a massive logical hurdle. If demand is rebounding like this, if net absorption just swung positive by 750,000 square feet, and massive companies like Dow are signing huge leases,
I know where you're going with this.
my instinct is that developers must be rushing out to capitalize on that demand. Are we seeing cranes going up all over the city to build more of this Class A space?
We are not. In fact, the construction pipeline data is perhaps the most critical element of this entire report when it comes to predicting how this market actually recovers over the next decade.
It really is shocking. The construction pipeline plummeted another 30% in Q2. Like, 30.2%. It is down to roughly 337,000 square feet of active development for the entire city.
Which is practically nothing for Houston.
Right. The report explicitly states this is one of the smallest active development pipelines Houston has seen in over 10 years. And what little is being built isn't speculative at all.
No, speculative development. The act of a developer borrowing money to build a giant shiny tower and just hoping tenants will show up to lease it once the glass is installed, that practice is completely paused.
Completely.
The only projects moving forward right now are build-to-suit, owner-occupied, or buildings that are almost entirely pre-leased before the phone shovel ever hits the dirt.
It sounds like developers have essentially hit the emergency brake on a freight train. It violently jolts all the passengers, but it keeps the whole thing from flying off the tracks entirely.
That's a very vivid way to picture it.
But wait, I have to push back here. Isn't a total lack of new construction a sign of a dying market? If nobody believes it's worth building a new tower, doesn't that mean nobody believes in the long-term future of the city's economy?
If we connect this to the bigger picture, this construction halt is actually the market's greatest strength right now. Hitting that emergency brake is exactly what the Houston office market needs to survive and eventually thrive again.
How does completely stopping growth help survival?
Because of that nearly 23% vacancy rate we started our conversation with, the market has an enormous amount of empty space that it desperately needs to digest.
Okay.
Think of the market like a sponge that is already completely saturated with water. You can't just keep pouring more water on it. By choking off the supply of new, shiny towers, developers and the banks that fund them are forcing the market to deal with the inventory that already exists.
So as companies expand or as their 10-year leases finally expire and they look for new space, they're forced to choose from the buildings that are already standing.
Exactly. It forces the absorption of the current emptiness, without the constant threat of brand new, completely empty towers flooding the zone and diluting the demand even further. It is a highly calculated, heavily disciplined path to a long-term recovery.
Plus, the capital markets simply aren't going to fund new construction right now anyway. No bank is going to hand a developer $300 million to build a speculative office tower when a quarter of the city is already empty.
Precisely. If developers were somehow able to build right now, they would trigger a total collapse in rental rates because the new supply would vastly outstrip the slowly recovering demand. By keeping the pipeline completely constrained, they're putting a hard floor under the market, allowing it to slowly, methodically heal.
Okay, the mechanics of that make perfect sense. But since nobody's building new towers, the big institutional investors, the pension funds, and private equity groups who have billions of dollars that they have to deploy somewhere to generate returns, they're having to look at buying the existing towers.
Yes, they are.
Which leads us to our final major theme of this report, the great repricing.
Yes, and this is where the financial realities of the post-pandemic world are hitting the ledger books in a very harsh, very undeniable way.
The standout transaction of Q2 is the perfect case study for this, and it involves a property called Greenway Plaza. For context, this isn't just a single building. Greenway Plaza is a massive 11-building, 4.5 million square foot mixed-use campus.
It is practically its own functioning city within Houston.
It is an absolute landmark asset, and the financial mechanics of how it just changed hands are breathtaking.
They really are.
Here's where it gets really interesting. The report notes that an investment group called Intera Properties acquired the Greenway Plaza portfolio from TriGuild. To do so, they assumed approximately $416 million in existing debt and paid just $15 million in cash.
Wow.
So they essentially acquired this massive footprint for a total valuation in the ballpark of $431 million.
Which sounds like an incredible amount of money until you look at the historical context of what this property used to be worth.
Just over a decade ago, in 2013, this exact same campus traded hands for roughly $950 million.
$1 billion asset trading for less than half its former value.
It is sheer, unadulterated value destruction. Over $500 million in equity just erased, poof, gone.
It's sobering.
How does something like this even happen mechanically? How does a real estate ecosystem survive a financial wipeout of that magnitude?
It happens because commercial real estate runs on cycles of debt. Commercial loans are usually structured as interest only for 5 or 10 years, and then the entire massive principal amount comes due all at once.
So they have to refinance.
Exactly. When the loan for a property like Greenway Plaza matures, the owners have to refinance. But in 2026, interest rates are vastly higher than they were a decade ago, and office vacancy is way up. When they went to refinance, the math simply didn't work. The building was generating less income, and the cost of the new debt was too high.
The building mathematically became worth less than the loan itself.
Exactly. So rather than pouring good money after bad, legacy owners in these situations are forced to hand the keys over or sell it at a massive discount just to clear the debt.
Wow.
It survives because this isn't a localized tragedy. It is a necessary market-wide repricing. The office market was operating on peak valuations formulated in 2019. The world has changed. The way we work has changed. The math simply had to reset to reflect current reality.
So it's less of a chaotic crash and more of a painful but necessary financial reality check.
Precisely. And the fact that this transaction happened at all is actually a highly positive signal for the future.
Why is that?
It shows that institutional capital is still very active. They aren't abandoning the office sector entirely, but they're being incredibly selective. They're targeting assets where this kind of painful financial reset has already occurred.
Ah, they are buying at the new bottom.
Yes, because if Intera Properties buys Greenway Plaza for $430 million instead of $1 billion, their monthly debt payments are massively lower.
Oh, that makes sense.
That lower cost basis gives them the financial breathing room to reinvest cash into upgrading those older buildings, adding the amenities we talked about earlier, and actively competing for that flight to quality tenant without having to charge sky-high base rents to cover an old, bloated mortgage. It unfreezes the market.
It really is a fascinating ecosystem. So to bring all of these different threads together and wrap up our journey through the Houston market, we are looking at an office landscape that is undoubtedly enduring some highly visible, painful shifts.
Without a doubt.
The sheer amount of empty space sitting at 23% and the massive loss in paper valuations like we just saw at Greenway Plaza prove that the old era of office real estate is over.
But the underlying fundamentals point to a market that is aggressively transitioning toward a quality-driven recovery.
Yeah.
It truly is a tale of two cities right now.
Right. You have the Class A buildings that are reaping all the rewards. They have the premium air filtration, the collaborative spaces, the prime locations, and they are successfully capturing the returning physical workforce, particularly from professional services and healthcare.
Right.
This demand is allowing those landlords to hold their ground and push rents higher despite the vacancy around them.
And supporting that recovery, you have a development pipeline that is remaining highly disciplined. By hitting the emergency brake on new supply, the market is ensuring that the current excess inventory gets absorbed without flooding the zone with new problems.
It's a very delicate but very deliberate balancing act.
It is. But synthesizing all of this data raises an important question, one that isn't explicitly answered by the numbers in the Lee and Associates report, but that the data inevitably points to.
What's that?
Well, the data absolutely proves that modern companies will happily pay top dollar for premium, structurally modern Class A buildings. At the exact same time, they are completely ignoring perfectly good, older Class B properties, even when they are offered at a massive $13 a foot discount.
The structural gap between the haves and the have-nots.
Exactly. So if this trend doesn't reverse, and considering the physical demands of modern work, there is absolutely no indication that it will, if this gap continues to widen over the next 5 to 10 years, what will ultimately become of these abandoned Class B buildings.
That is the elephant in the room. I mean, you can't just leave millions of square feet of concrete and steel sitting empty in the middle of a downtown grid forever.
You can't. The carrying costs alone on property taxes and maintenance will eventually bankrupt the owners. So what happens? Will the engineering challenges of plumbing and floor plates be overcome to turn them into massive residential hubs to solve urban housing crises? Will they be completely gutted and turned into vertical farms or high-tech logistics hubs to feed and supply urban populations? Or will they simply be subjected to the wrecking ball and demolished to make way for parks and entirely new infrastructure?
It really makes you rethink the future of the skyline.
It does, because the future of the urban downtown might not actually be defined by the shiny new skyscrapers being built. It might ultimately be defined by what we decide to do with all the older legacy buildings left behind in the flight to quality.
It's like staring at that half-empty movie theater we talked about at the very beginning. Sure, management found a way to charge people in the premium recliner seats a lot more money to keep the lights on today. But eventually you have to figure out what to do with all those empty rows in the back, or you're going to have to tear down the theater and build something else entirely. Something for all of you to mull over the next time you look up at the skyline of your own city. Thanks for joining us, and we'll catch you on the next deep dive.